These are the 8 stocks I bought this month that helped me make $352 a month for doing absolutely nothing. Before we get started, smash the like button and the subscribe button if you're interested in learning more about money, how to make more or save more, or just understand it better. My first investment was in the S&P 500, or the 500 biggest companies in the United States of America, through this ETF called VFV. I bought around $400 worth of it, adding on to my already existing position, which now pays me $80 to $90 every quarter. The S&P 500 has been up 10% on average for the last 40 years, with it almost doubling in the last 5 years alone. These dividend payments are an added bonus onto the already very strong growth and an incentive for me to keep on investing in the stock index, polling the 500 biggest companies in the best economy on the planet, the flag bearers of freedom, capitalism, pro-max, etc, etc. My next investment was in the Canadian S&P 500, or the TSX 60, the 60 biggest companies in Canada, through this ETF called VDY. VDY is very interesting because it's not as growth focused as the S&P 500, and the returns, as you can see, are not that high, with my return only being 11%, and over the last 5 years, S&P 500 beating it by almost double. The key part to note is the dividend yield here. It yields around 4.5 to 4.7%, and even though I have significantly less money invested in VDY, I have more dividends that I receive every month deposited into my bank account, to the tune of now $80 to $90 every single month. With Canadian industries like telecom and like banking and energy not going anywhere anytime soon, the population increasing rapidly, and everybody needing essential services, this is not going to go anywhere anytime soon, and I'm going to keep on buying this and hopefully pushing this to $100 every month. My next ETF investment was in HYLD, or the Hamilton Covered Call ETF, tracking the S&P 500 roughly. The yield on this is absolutely massive at 12%, although the growth performance is not that good compared to a regular growth ETF, since they deploy a covered call strategy. That essentially means they sacrifice the potential growth to give you income now. For me, income is a big motivating factor, which is why I choose to invest in covered call ETFs, with HYLD in particular returning me around $82 every single month. Of course, the amount invested is much lower than my growth ETF, since I do hold for the long term and do want to invest in growth heavily. I still need that motivation to keep consistent and keep on saving, which is why I bought HYLD. With this ETF in particular, you will notice that they don't write calls on 100% of their holdings, which essentially means they're trying to balance income with a bit of growth. If they write calls on 100% of their portfolio, they would have much higher premium, although the growth would be capped, which, as we can see, has been the case with other covered call ETFs in the past. Before we get on to the other investments, I just want to show you this very quickly. I live in Toronto and I have considered investing in real estate, but I want to buy a cash flow positive property. When I talk about investing in the stock market and dividends with anybody who likes real estate, they always bring up, why not just buy a cash flow property? You can build equity and you can get like cash flow and you can be extremely rich. Well, there's a problem with that. 90% of condos and a large percentage of properties in the Toronto market and also the Canadian market are cash flow negative, which essentially means that, taking into account the mortgage payment, the interest, the principal return, strata fee, all sorts of maintenance and repairs, you end up losing a significant amount of money every single month, with condos in particular being the worst type of investment right now. And shout out to this YouTuber pre-condo for this statistic. I couldn't find any data for any other cities, but the point to note is that as many properties are cash flow negative, you're essentially losing money to hold on to the property, and historically the stock market has beat the real estate market by double in price appreciation. So if I can grow at an average of 7 to 8% every year and also still get those dividend payments at a decent enough yield, I'm way better than the average real estate investor. A slight tangent, but just my 2 cents on why I prefer investing in the stock market versus the real estate market. Not to mention the other hassles that go on with real estate, like finding a tenant, what if you get a bad tenant, maintenance fees and repairs that we've already talked about, getting that good property manager that can manage everything for you. I don't have to worry about any of that if I invest in the stock market. Vanguard is not knocking on my door and saying the tenant didn't pay. That's just not gonna happen. My fourth investment was in HDIF. This is also an Hamilton ETF, just now tracking the Canadian market with a bit of US coverage as well. Once again, the yield is extremely high at around 12 to 13%, although the growth is slightly limited. If you do compare it to the performance of the TSX 60 though in the past few years, they're basically tied. Essentially, that's telling me I can get a much higher dividend yield and still maintain a relatively nice growth performance. Not a lot of money invested in this, but still enough to get me $60 every single month. My last ETF buy that pays me dividends was HEQL. This is a Global X product that is a total market ETF with a bit of leverage. Leverage essentially means that the performance is magnified, both the positive end and the negative end. So if the market, the total market, the US market and the Canadian market, along with international markets, go up 10%, this ETF is going to go up 12.5% since it adds on 25% leverage. Roughly though, because there's some leverage costs in terms of the interest payments and the debt restructuring, so you will get a slightly less return. Let's just call it 12%. On the other hand though, if the market goes down 10%, this ETF is going to go down 12.5%. plus the leverage cost, so around 13% or thereabouts. You can see the pros and cons here, but I choose to add on to this because this does pay me dividends every month as well. Only $3 or so a month for now, although the main play here is once again the growth. I'm still getting dividends, the stock market hopefully will continue to grow, so there's upside there as well, and the total return will be magnified 10, 20, 30 years down the line since I am young right now and I am not going to withdraw from this portfolio. Moving on to the individual companies, my first buy was P&G, Procter & Gamble. They make diapers, they make baby powder, they make toilet paper, they make cereal, they make air freshener, they make snacks, they make drinks, they make beauty products, like anything you want in life you can probably get through P&G. They own hundreds, or I don't know about hundreds, but they own dozens, multiple dozens of the biggest brands on earth, and their revenues and profit margins have been expanding in the last few years while also expanding their dividend, which is why I invest in P&G primarily. The high growth rate and already juicy yield of around 2.5% signals to me that P&G is going to keep on increasing dividend in the future as well, given their increasing revenue and decent profit margins. The important thing to know about these CPG or consumer packaged goods companies is that they have enough cash to buy any upcoming brand that will add on to their portfolio. So I chose to buy one share of P&G, and this now pays me more than $30 every quarter. My next individual company purchase was Microsoft. Microsoft is a behemoth. Microsoft Office with Microsoft Word and PowerPoint and Excel are used by millions of businesses across the world. Microsoft Azure, their cloud product, which supports not just old companies, but new and up-and-coming companies as well. Their partnership now with OpenAI to build OpenAI products on top of Azure, while also making products like Microsoft Teams, and who can forget Windows, which apparently 99% of the world runs on. If Windows doesn't work, you cannot fly, you cannot land, you cannot go to the bank, you cannot do anything. All this while consistently increasing revenue and profit margins, also increasing their dividends by more than 10% over the last few years. Microsoft is a behemoth. I'll say that again, Microsoft is a behemoth. Although it only pays me around $10 every time, this is going to be a big play for me in the future, given how rapidly they're increasing their dividend, along with the stock price appreciation. Once again, I am holding for 10, 20, 30 years hopefully, and I will not need to see this money tomorrow. I don't have to worry about selling this and getting some of those gains. I can just wait for Microsoft to keep on increasing their dividend and realize gains later. So those were the 7 stocks, and now we're gonna talk about crypto, Ethereum. Ethereum is a cryptocurrency a lot of companies are building on to solve real problems. Whether in the finance space with the slow and tedious banking industry, or other spaces like the legal industry, which has a lot of processes, companies are building on the Ethereum blockchain. And of course, I buy Ethereum for the increase in price and the capital appreciation, but I also stake my Ethereum for some yield. Staking essentially means you lend your crypto to certified transactions on the blockchain, and you get a slight reward for that. For now, this is 3.2% of the amount staked at the broker that I use. Well, simple. This might be different at your broker and other brokers. I'm just telling you the rate that I get. And although this amount is very small for me right now because my crypto investment is not that big, I want to hold crypto for an extremely long time, since this is not a short-sighted industry. If it does play out the way that a lot of people think it's going to play out, it's not going to happen 10 years into the future. It's going to take much longer than that, given the bureaucracy and given how slowly things move from a legal and financial regulation perspective. And while I'm holding, why not get paid for it? Which is essentially why I stake my crypto. Once again, I don't recommend this. This is not advice or financial advice. I guess I have to say that. I do this personally because I don't really care if crypto goes up or down in the short run. I'm holding for the long run, and I just want to get paid, quote unquote, for my investment in the short run as well. And this month I am expected to make $337 in dividends. You will notice some months it's much higher. For example, the months of January, April, July, and October, with this amount being as high as $490 sometimes. On the other hand though, some months are extremely low, with February being only $280 a month. That is just the nature of dividends, because a lot of companies and ETFs only pay quarterly. That is why these large peaks and valleys exist. Although if you average it out, like it says here, I get around $352 a month or $11.58 a day. And as I mentioned, with my only comparison or comparative asset being a rental property, this is a much better deal since most rental properties are in fact cash flow negative and the capital appreciation is not as high as the stock market. That is just my basic understanding right now. I might be wrong, but it's looking good for now, especially in this environment with high interest rates and high mortgage payments. If you enjoyed this breakdown and this transparency, smash the like button and the subscribe button. It helps me reach more people and the YouTube algorithm loves it. You have to do it for the algorithm. I'll see you in the next one.